Welcome back. I'm Tiffany Meyer. In a rare visit to the Federal Reserve, President Trump toured the central bank's ongoing renovations. The visit comes amid Trump's public criticism of Fed Chair Jerome Powell over interest rates. Joining us now to discuss is economist Vance Ginn. He's the president of Ginn Economic Consulting and a senior fellow at Young Americans for Liberty. Vance, thank you so much for joining us. Great to see you again. Now, the visit kicked off almost immediately with a disagreement, with Trump saying construction costs have ballooned to $3.1 billion and Powell disputing it. Zooming out a bit, there has been some criticism of this construction project, given that the Fed is supposed to be independent and fiscally responsible. How are you reading this?
Well, it's a pleasure to be with you, and I don't see that they're being fiscally responsible with their own operating budget. Not only are they running hundreds of billions of dollars in losses because they didn't manage their interest rate spread correctly, but now it could be 700 million, if not more than $1 billion in overrun from the initial 1.9 billion dollar amount that was going towards these renovations. They could now be close to 3.1 billion, as the president mentioned today. This is not how you run an institution. This is not how you supposedly run an economy. If this is the way they want to go, then they're completely failing, not only on the economic measures, but also on how they're renovating their own building. And so I think there's some major problems going on at the Fed by Jerome Powell.
Now, leading up to this trip, there's been some speculation that Trump might fire Powell, with analysts saying that would threaten the Fed's independence. Although today, when asked by a reporter, the president says he won't fire the Fed chair and that he believes Powell will, quote, do the right thing. What is your view of this?
Well, there's always been this idea that the Federal Reserve is independent and the president shouldn't have influence over the Fed, given that they control monetary policy and the amount of money supply in circulation. And now there's currently $6.7 trillion of assets on the Federal Reserve's balance sheet. So they are manipulating a lot of the economy. I mean, that's about 23% of GDP is just on their balance sheet. In that sense, if you think about it that way. And so now President Trump is basically asking questions, what's going on at the Fed? Senator Rand Paul has been calling for auditing the Fed. I think that would be a good step in the right direction. And so I'm not so sure the president should jawbone and try to bring down interest rates, especially at a time when inflation is well above the 2% inflation rate target. But at the same time, there should be questions asked to the Federal Reserve. They're not as independent as they look. They're definitely in connection with everything else going on in the economy. And when the Congress is already running $2 trillion plus deficits per year and $37 trillion in national debt, if interest rates are higher, you're going to pay more interest on that debt, and lowering it will mean more inflation. So they're caught in a bad situation, which really comes down to the Fed cutting its balance sheet and Congress cutting spending, which they seem unlikely to do.
Now, digging into that a bit, talk to us about what it means for the Fed to be independent as it was intended.
Well, I think it was intended. The Federal Reserve Act in 1913 created the Federal Reserve. There's been some changes over the years, over the decades since then. But really, it should mean that the Federal Reserve Chair should have independence, along with the FOMC, the Federal Open Market Committee, to make independent Federal Reserve decisions about monetary policy on their inflation rates, on their interest rate targets, and things of that nature that are separate or independent of what Congress is doing, what the president is doing. And so there should be some independence in that sense. The problem is if you look throughout history, is that they oftentimes are not independent. They do tend to work together and things of that nature. And sometimes there could be making bad decisions. I think quite often contributing to the inflationary pressures and the less economic growth that we have across the economy. And we're seeing that today. I think that the Fed printed too much money and they kept their interest rates too low for too long. Then they raised them and now they've come back down a little bit again. But the Federal Reserve's balance sheet is $6.7 trillion. That's not much independence.
Now, speaking of interest rates, Trump has criticized Powell for months over the Fed keeping the short-term interest rate at 4.3% this year after cutting it 3 times last year. Now, Powell says the Fed wants to wait and see how the economy responds to Trump's sweeping tariffs before making other changes, as he says those tariffs could push up inflation. What do you make of these two arguments?
Well, I mean, if you look at both of these, inflation overall is running about 2.7% headline inflation. The core, which exclude food and energy, the more stable prices that are out there, is closer to 2.9%. So those are well above the inflation rate target that's set by the Fed of 2%, which indicates that they shouldn't be lowering interest rates. Because if they lower interest rates, that means they buy Treasury securities, they print money, put more money in circulation. If you have more money chasing fewer goods or not as many goods, then you're going to get higher inflation. And that's what we had happened in the 1970s that I don't want to see happen again here in the 2020s. At the same time, unemployment rate shows 4.1%. There's some weaknesses that are here and there, but the Fed doesn't have any control over the labor market. They really only have control over inflation. And that's why I do not think that they should be lowering interest rates right now, and instead should be continuing to reduce their balance sheet. And that will help to correct a lot of the markets throughout the economy. And hopefully with the tax cuts made permanent from the One Big Beautiful Bill that Trump had pushed and everything else, I think that will allow for more economic growth and prosperity from pro-growth reforms. And by the way, too, the Fed's got to get out of this over-regulation sort of policy from Basel III and other types of financial regulations. They're really contracting a lot of loans to everyday Americans.
And Vance, from a different perspective, should the president have a say in the Fed's monetary policy?
Well, I think a president can say whatever they want. They got the bully pulpit of the presidency. While at the same time, it doesn't mean that the Federal Reserve Chair has to listen and go off of that. Because what I'd rather not see is for monetary policy to be conducted through a lot of politics and creating more uncertainty in the overall economy. I'd rather it be done through rules-based policy actions, and that means not having the president come in and say what should exactly happen with those interest rates over time. But at the end of the day, I think a president has a right, that has the ability, the freedom of speech to say what they want about what the Fed should be doing. But you don't always see the Fed have to make those same decisions. And so that's where I'm kind of at on this right now.
All right, Vance, again, as always, thank you so much for joining us.
Thank you.